Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, March 31st. Treasury Secretary Henry Paulson unveiled a proposal to overhaul the system of financial regulation in the United States. It is a striking proposal on a number of levels, but ultimately it's not expected to amount to much in the near term. One of the main thrusts of the plan is to streamline bureaucracy in the regulatory system. We're all for that, but talk about your oxymorons. In any event, Paulson aims to do more with less in this regulatory overhaul. Less, however, means fewer regulatory agencies. Given the growth of the financial system and its increasing complexity, it's hard to imagine doing more on the regulatory front with fewer workers. When it comes to reducing the bureaucracy, one element of the plan that is attracting a lot of attention is a recommendation to merge the SEC with the Commodity Futures Trading Commission. Such a move essentially does away with the SEC as we know it today. Separately, the recommendation makes it sound like the SEC would be a subsidiary, so to speak, of the CFTC. Might this be a tacit acknowledgement of the growing influence of the commodity asset class? We digress, but it's an interesting development in its own right. Another hot-button topic is the idea of giving the Federal Reserve a roving oversight role that would take it away from providing direct bank supervision and hand it authority to lord over basically any company that has the potential to destabilize financial markets. Other proposals, but not all of them, include establishing a mortgage origination commission, shutting down the Office of Thrift Supervision, and offering a federal charter for insurance companies which have been regulated by states. The sweeping nature of the proposal is noteworthy, as is the underlying motive to create a regulatory process that is not only more modern, but also makes the U.S. financial system more competitive in the global marketplace. It has been reported that Paulson's plan took shape last spring in an effort to improve the bureaucratic structure, not address the current crisis in the financial markets. The plan for the latter continues to take shape on a real-time basis. Nonetheless, the Paulson proposal will now be part of the market's assessment of what needs to be done to prevent a similar crisis from unfolding in the future. This isn't to say the market agrees with the proposal, just that it will be taken into account as the market contemplates the repair process. The issue of regulation typically does not sit well with the market, particularly when it sounds as if there will be stronger oversight, whether it is in a streamlined fashion or not. It seems all but certain, though, in the wake of the subprime crisis and the Fed opening the discount window to investment firms, that the oversight of financial activity is going to increase. How that unfolds remains to be seen. Treasury Secretary Paulson has provided a basis for discussion, though not an edict for the ultimate solution. A sweeping overhaul of the regulatory system will not come quickly. Nothing ever does in a bureaucratic framework, and especially when you're in a presidential election year. Potentially, the regulatory solution could take so long to work out that it might be considered draconian when the time finally comes to enact it. That notion is anathema in the current environment, we know, but when times are good and lots of people from Wall Street to Main Street are making money again, the last thing anyone wants to see unfold is increased government intervention. If anything, that's usually the time when businesses, investors, and office-seeking politicians alike are clamoring for less intervention. I'm Pat O'Hare for Briefing.com. Thanks for listening.